Hello, this is Stacy Francis from Francis Financial and Savvy Ladies. It's great to have you here today. We're going to be going over a lot of information that is as timely as can be. In addition to the massive snowstorm that we saw here in the East Coast, we also have seen major headlines with what's going on in the market. In fact, we've never had a year where we've started off the new year in such a dramatic way. We've never seen such volatility in the month of January alone. So this is definitely timely, and that's part of the reason why I know that we actually have a record number of attendees here. What we're going to be talking about is the investment forecast both for the year 2016, actually forward for the next 5 years, as well as we're going to talk a little bit about what happened in 2015, which was a whole lot, as we all know. On top of that, we're going to give you what's equivalent of PEPSID in financial planning terms. And that PEPSID that we're going to be talking to you about is how do you put this current volatility in context of what's happened historically? How do you, as an investor, navigate the ups and the downs of the market? Should you be doing something or should you not be doing something? These are all the things that we're going to talk about and the answers that we're going to give you and that you're going to walk away with today. And don't worry, this is going to be recorded. So if you need to jump out for a meeting or you know of another person who care for or love that would really benefit from that peace of mind of understanding more about their life, about their financial goals, about their portfolio, we will be sure to send this out to you. So without further ado, let's get going because we've got a lot of material to go for. So first we're going to talk about our role as financial planners. What does this mean? How can you effectively work with a financial planner if you're working on your own? How can you be your own financial planner? We're then going to talk about the market review. What happened in 2015? And so far, what's going on in 2016? And then finally, looking forward to the future of not just this year, but 3, 4, even 5 years out. So what is the role of a financial planner? It's, number one, to help you create a plan. Creating a plan with the proper mix of investments, the proper mix of stocks versus bonds, which is different for everyone, and actually different for everyone on this call. At the same time, helping you control what you can by investing in a broad range of investments, making sure that they're low cost, that you have the most tax-efficient portfolio as possible, and a portfolio that's going to help you reach your goals. The number 2 reason as a financial planner, what you want to do for your clients and for you as an investor is once you create that plan, that you stick with it. And that means in the ups as well as the downs, staying invested for the long term. We're going to give you some really important tools that you can use that are going to help you do just that. And adjusting that plan. Your plan that you made 5 years ago may not be the plan that's right for you now. Also, as your investments grow at different paces, you need to annually tweak your portfolio and bring it back into balance. So with that, let's talk a little bit about creating that plan. So what is your ideal mix of stocks, your ideal mix of bonds? This is a fantastic chart that shows you the spectrum of returns of different stock and bond allocations, starting from 1926 all the way through to present, all the way back to 2013. How do we read this? Well, Vanguard was kind enough to put this together for us, and you can see that if you're 100% bonds, which are considered of this investment, some of the most conservative investments, that your return on average from 1926 through 2013, you would have had a return of about 5.5% a year. Now, what about the best year since then? Well, the best year going back to 1926, you had a 32.6% return. Not so bad. Now, what about the worst year? And we all can kind of point to when we know that was 2008. You had a negative 8.1% return. Now, as we move to the right here, and you can see my cursor going, there's a change. And the change is that over this graph, we can see we're getting more aggressive as we go to the right. We find ourselves at the exact opposite, 100% stocks. On average, our return was pretty nice, 10.2% each year going all the way back to 1926. And it also includes our best year, a 54% return. Now, what about the worst? You got it, 2008, a negative 43.1% return. So what is this chart telling us? Well, it's telling us that the higher return you want, the more risk you're going to have in your portfolio. And with the more risk, you're going to see potentially in any 1 year greater losses. So what I want you to do is to see which of these portfolios would you stick with. No one has a problem getting a 32% return that you can see here if you had 50% stocks and 50% bonds. But many of us might have a problem if we invested $100,000 and we saw $22,500 vanish from our portfolios. This is all part of making a plan. And that plan is choosing the right mix of stocks and bonds. That's the first piece. Now, in creating that plan, once you have that mix of stocks and bonds, you want to make sure that even within those categories, you're diversified. So our goal is to invest across as many categories as we reasonably can. So for stocks, you're going to want to have large company stocks, medium and small, international developed countries such as Canada, the UK, and international emerging market countries. For bonds, you're going to want to have U.S. exposure, possibly international, maybe even inflation protected. These are all other types of bonds that you can consider. So if you wanted to be a smart person and choose the investment that was the highest performing investment across all the time periods, and here we're going all the way back to 2005, which of them would it be? Well, the answer is this. Over time, since 2005 to now, the asset class that did the best were mid-sized stocks. So middle-sized companies that did the best. In fact, that return is pretty darn amazing. On average, the return was 9.56% over those years, going all the way back to 2005. But what I want to show you, while that sounds like a smart thing to do, it isn't necessarily the best thing to do. Because look at this. You can see the returns this asset class got in 2005. Not so bad. Then not necessarily the best stock in 2006 or 7. A big dip, a 41% loss in 2008. A recovery in 2009 and 10, back down to a loss in 2011, and then slowly coming back up. In fact, what about the next asset class? Here we're talking about the second most productive asset class during that time was emerging markets with an 8.43% return. How did that do during this time period? Well, we prepared that for you, and you can see that it did very well in 2005, 2006, 2007, had a massive loss, a 53% loss in 2008, a recovery, and then down to another loss, another recovery, and then down for more losses. What about this next asset class? More of real estate securities. Well, you can see not exactly a smooth pace for that, What about the S&P 500? We all talk about how's the market doing. And when people say how's the market doing, they're really talking about the S&P 500. That's the 500 largest stocks on the stock market. And you can see it didn't do too bad, but pretty average and mediocre until most recently. So what this shows you, just all these different asset classes that I'm going through. This is small company stocks. This is bonds, international, Treasury inflation protected security bonds, and a few others that we have here. So ultimately, what this is showing you is that you don't want to invest in just one asset class, because every year you're going to have returns that are different for each. So what you can control is also being tax efficient. Who wants to pay more to Uncle Sam than you really have to? Well, that's unfortunately what a lot of investors do. By being smart about where you put your investments can save you thousands of dollars each year. So, for example, those investments that are the least tax efficient, we're going to want to put in retirement accounts. So what investments are the least tax efficient? Well, they're the ones who you have to pay the most taxes on every dollar you earn in them. A good example, bonds. When you have a bond and you get $1 of interest paid to you, you have to pay federal, state, and if you live in New York City local taxes, Social Security, Medicare. After that dollar is paid to you, you might only be getting 60 cents in your pocket. It's pretty painful. So be smart about where your bonds are. It would be ideal to put them in these retirement accounts. Why? Because every year that these accounts create money, all that interest, any dividends, you don't have to pay taxes on right now. Not until you finally take the money out, which could be as late as 70 and a half, which is also known as when you have to take out required minimum distributions. Now, what about those investments that are the most tax efficient? And those typically are stocks, because when stocks make money, it's called capital gain. And the tax rate that you pay on them is a lot less than the tax rate you would pay on bond interest. We call it capital gains tax. So for those, since they're so tax efficient and the amount that you have to pay on the growth is so much less than you would have to pay in the same dollar amount you're getting from a bond, we could put them in non-retirement accounts. A non-retirement account, you can also call it a taxable account, a brokerage account, things that are not called IRAs or 401ks. They're just your regular investment accounts. Why does this matter? Well, it matters for a good amount for many of us, because on average, and it depends on the study you read, but it adds anywhere from a 1 to a 3% return each year to your effective return. That means your after-tax, what you take home at the end of the day return. And to be honest, isn't that what we care about? Yeah, we want to know how much money are we making after we pay in taxes. By the small, simple move of being smart where you put assets, bonds typically in retirement plans, and stocks typically in non-retirement plans, you can add and boost your return after tax without any more risk. Who doesn't want that? So with that, what's the next thing you want to think about? You next want to think about cost. The ideal is to invest with the lowest cost possible. Whenever you are reviewing an investment, you want to look at the performance, you want to look at the risk, but you also want to look at the cost. There are plenty of investments that we would love to have our clients in that unfortunately we can't. Why? Because they're too expensive. When you look at that return, you have to understand, well, what's my return after the cost of this investment? It's kind of like walking into a store. Could you ever imagine walking into Bloomingdale's and picking out 5 outfits never even once looking at the price until you got up to the cash register. We wouldn't do it. We just wouldn't do it. It's the same thing of how we look at investments. You have to look at everything, and the price tag is a really big piece. So how do you stick to the plan? Sticking to the plan is one of the hardest things you can do. In fact, what happens here is that excitement builds as the market rises, and this is showing you the market. Investors are happy with performance, and they're eager to join in these good times. So often right up here at the top of the market, more people are jumping in the market and buying at prices are, unfortunately, where we know, we can see it's at their peak. But after the market peaks, we start to see what? We start to see prices declining. Investors start to worry. And as this continues to fall, people become increasingly wary of how much further these prices might go down, how much these prices might fall further. And eventually, what ends up happening, individuals get to the point where they are paralyzed. They cannot handle the losses any longer because they're invested in a mix of stocks and bonds that's not right for them. And what do? They pull out their investments, often resulting in really good losses, really big losses. Essentially what they're doing is they're turning a temporary decline into a permanent loss. And this is a loss that they could continue to feel holding them back in their portfolio for many, many years. This is the worst thing that any investor could do, and that is buying high and selling low. After that individual gets out of the market, they might find themselves seeing the market go back up. And as that market goes up, they start to gain confidence, feel more confident in the market itself, and then once again, getting back in the market at the complete wrong time. So what does this do? Well, unfortunately, it creates an emotional roller coaster. That optimism, excitement, thrill, euphoria, where we're willing to take on the highest risk. This is actually where individuals are most willing to take on the highest risk. And then as the investor starts to panic, it doesn't matter about history, study, the different studies or statistics showing that you need to stay invested. That all goes out the window. And unfortunately, it is that point where investors can no longer handle and take the pain. And that's usually at the tail end of the market downturn, before we start to see the market rebound and increase in value again. A sharp rebound, we know, always occurs right after the market drops. And this chart, what it's showing you is it's helping you visualize the feelings that many investors experience. So know that as you experience these, that this is normal. But it leads to something called the behavior gap. The behavior gap is a scientific term that is used to describe the difference between your typical average investor returns versus the returns that the markets give and the returns that you would get if you worked with an investment professional. And you can see that there's a pretty big gap. There have been 7 different companies, as well as several others, but 7 different independent companies that have really focused on this investor gap and tried to quantify what does it really look like. And this is what it really looks like. So Dalbar is one of my favorite that I follow quite regularly. And they looked at the percent difference in annual returns between your average investor versus the markets and working with an advisor. So here you can see at one of the larger behavior gaps, they're saying that 4.3% negative return, that the average investor is getting 4.3% less in investment returns than they are if they were just going to be following the markets. As well as other areas. You can see this is a 6.5% return. This is specifically for active traders. So Baber actually did not only the average investor like you and I, but also those people that can call themselves day traders. And interestingly enough, and it's going to make you feel much better about yourself, that according to Baber, you might only be 1.5% behind of what the market's doing based on that behavioral gap. But day traders are far further behind with a drop of 6.5% below what the average market's returning. So what does this tell you? It tells you that, number one, day trading is really not profitable. But it also tells you that our worst enemy, unfortunately, our worst enemy is ourselves. So how does the average investor stack up? So this looks at the 20-year return through December 2013. And it shows you what return you would have received on an annual basis if you had invested in the top 500 large stocks, the S&P 500, versus the average investor. So the average investor would have had a 5.02% return each year over those last 20 years, whereas the market itself went up 9.22%. So if you're asking, well, maybe this equity investor had some bonds, no, I want to make it very clear that this is an investor that put 100% of their money in stocks. Here we have those investors that invest only in bonds. So the average bond investor investing 100% of their money in bonds did not even have a positive, more than a 1% return. In fact, it's below 1%, 0.71% return each year over the last 20 years. These people did not even keep up with inflation. Inflation over that time period was 2.37%. So effectively, they lost money. However, if we look at the index, the Barclay Aggregate Bond Index, you can see that the index of straight bonds did a whole lot better than individuals did on their own. It was a return of 5.74%. So, what about saying that you're going to day trade or market time, meaning putting your money in the market at the exact perfect time and taking it out at the perfect time? And to be honest, faced with a volatile market or a down market like we're seeing today, for many people you may become wary. You may want to market time. You may decide that it's too much and pulling entirely out of the market. Well, unfortunately, that leads to underperformance. And as you see here, missing just a handful of the top performing days can significantly reduce your portfolio's return. So here's an example. If you had stayed invested over those 20 years that we spoke about, your return over that time period, the amount of your portfolio would have been $654,000 if you had started investing with $100,000. Now, over those 20 years, if you had missed the top 5 days, that $100,000 investment only would have grown to $433,000. Now, what about if you missed the top 10 days? Those top 10 days, that $100,000 would have grown to $326,000. So you can see here the difference of just missing those 10 days versus staying invested in the good times and bad times, that you essentially are down by over $300,000. This is part of the reason why it's so important for you to know that in the good times and the bad times that you want to stay invested the entire time period. What about 2008? Because I know what you're saying to yourself, and I get it. What about 2008? How would this have looked specifically for those people in 2008? So we took an analysis to see what happened. We looked at three different factors. The people that sold all their stocks during the peak of the market turmoil and never got back in. The people who sold the stocks and then jumped back in once the market really hit its low, which was pretty much February 2009. And the people who stayed invested throughout and maintained exposure to stocks and bonds with their normal asset allocation as they had initially set up and rode through the market turmoil. I mean, this speaks for itself. Those people who sold all their stocks and stayed out, they're still negative. Those people who sold out and then jumped back in as the market was continuing to recover, not such a great return. And those people who stayed invested throughout had a return of almost 22% a year. So a question that you may have is, knowing this information, knowing that staying invested in good times and bad is the right thing to do. You can see the studies that we have here. You can see the history that we have here. Why is it that we have such a hard time when we know what is rational to do, but we're feeling the exact opposite and often acting in a irrational way? Well, it's something that's prehistoric. It's something called the lizard brain. So what can you do to make more thoughtful decisions about your investments, despite the emotional impulses that are natural, that we're all going to feel? Because investing, I believe, it's challenging enough without bringing any emotions into the equation. In fact, we're emotional, and as a result, investors typically place too much reliance on our feelings rather than really relying on the objective information that we have to drive our rational decision making. And so why do investors make irrational decisions? Well, it's the short answer. Right here, this little part of our brain called amygdala. Now, this is a part of brain that is almond-shaped, and it controls our ancestors' urge to flee ferocious lions. Well, over time, we don't really have that same threat of ferocious lions, ready to eat us in our modern day lives, but we still have that lizard brain that's operating in full gear, worrying about other fearful things such as geopolitical or economic headlines that are very scary. So when the brain is functioning properly, then the prefrontal cortex is that part of the brain that is in charge of reasoning is in control. It's actively communicating with the other parts of the brain. But sadly, and really for our investors, especially right now, the emotional response from this lizard-like part of the brain dominates the rational part of our prefrontal cortex. So the good news is that there's a reason. There's a reason that we have these emotions, and there's a reason that we sometimes make irrational decisions, even though they feel rational to us. So how do you do this? How do you overcome your lizard brain? Because as we know, there are lots of investors out there that have done very well, that have not let the lizard brain impact them, that are able to put all of the outside information that they receive in context and be able to still make very smart investment decisions. The best investors and traders really have developed the ability to separate these emotions from rational decision making. The number one key thing you can do is probably not what you would expect me to say. The number one key thing you can do is to turn off your TV, is to not buy what I call financial porn. Those are magazines, periodicals, newspapers that have sensational headlines that scare the bejeebers out of you, that do an effective job of selling that magazine, that newspaper to you, but long term push you the wrong way to making the wrong decisions for your portfolio for the long run. In fact, there's a famed investor, William O'Neill, summed this up really nicely, and this is a quote by him. Quote, "Since the market tends to go in opposite directions of what the majority of people think, I would say 95% of these people you hear on TV shows are giving you their personal opinion. And personal opinions are almost always worthless. Facts and markets are much more reliable." So let's talk a little bit more about how our brain reacts. Because there's another interesting piece about the lizard brain is its ability to distort reality. Several behavioral economics, and actually they received a Nobel Prize for this study, found that the pain of losing $50 is more than twice as painful as the pleasure of a $50 gain. Common sense would dictate that the pain you feel, the severity of pain of losing $15 or $50 would be equivalent to the same euphoria or happiness you would get of gaining or winning or earning $15. But that's actually not the case. And with that, we have different perceptions for risk. And your risk tolerance, what you can handle and still stick with your plan, is much better measured when you're looking at what loss can you handle versus what type of gain you can handle. Knowing that a 50% loss is going to be 2 times as difficult for you to deal with as the euphoria and the happiness that you're going to get with a $50 gain. And typically what we see is that as the markets go up, our appetite for risk, the amount of risk we can handle, also goes up. But as markets come down, when the market bottoms, we have that opposite tendency. Our appetite for risk, the amount of risk we can handle, actually goes down significantly. So when you're looking at that perfect mix of stocks and bonds, think about it in 2 different ways. Think about it definitely in relation to what portfolio mix of stocks and bonds is going to get me to my goals. But secondly, think about the losses that this portfolio could potentially deliver in any one year. And ask yourself seriously, can you handle it? And not just, can I handle a 10% loss, but make it real. If I have $1 million invested and I see $100,000 vanish, how is that going to make me feel? And what are a few other tips for you to help get beyond the lizard brain? Well, it's all about what I call gains. It's that, gyrations in the market, the ups and downs are normal and they're healthy. Allocation is key. Be right out of the starting gates with that good, perfect mix for you of stocks and bonds. That is the most important piece that's going to add to your investment returns over time. Invest for the long term. Don't even think about investing in the stock market if your time horizon is 2 years. It's completely inappropriate, and it's something that you should not be doing. Investing for the long term versus 3 years out is when you should be investing more so in the stock market. And never let emotions drive decisions. Check yourself. Is it the lizard brain talking? And S. Savings is the most important, and unfortunately we forget that. So those of us that can save, that's something you have control of. Think of all the things you don't have control with, particularly with the stock market. Well, how much you save, that is the biggest determinant of whether or not you're going to gain financial security. And the great news is guess what? That's something that you have control over. So how do you adjust the plan? How do you adjust the plan if maybe your goals have changed? You're getting closer to retirement. How do you adjust the plan if certain parts of your portfolio have grown much faster? Maybe your stock section has grown much faster than your bonds. How do you adjust that plan to make sure that you're still on track? Well, for example, in this situation, this person's ideal mix of stocks and bonds is 60% stocks and 40% bonds. Due to life events or market movements, we need to shift it back to that ideal allocation. It's grown to 70% stocks and the bonds are now only 30%. So how do you do that? Well, you take the emotion out. Doesn't matter what's going on in the market, but you are smart. And you bring it back to 60% stocks and 40% bonds. By doing this, essentially what you're doing is you're buying low and you're selling high. Here we sold 10% of our stock holdings that had grown to be much more valuable. We're selling them at the high. And then we're reinvesting in bonds that maybe haven't done as well. This is the perfect strategy of, again, buying low, buying bonds when they're at that lower price, and selling high where stocks have grown and they're at much a higher price in the market. This is one of the most important things you can do. So we've talked about three different things. We've talked about what an ideal planner will do for you by, number one, creating a plan, or you on your own creating a plan. Number two, we've talked about how to stick to that plan in good times and bad. And number three, we've talked about how do you adjust the plan when your stocks grow faster than your bonds, which is typical, or due to life events, there are changes that you need to make to bring back to that ideal asset allocation of stocks and bonds. Now we're going to talk about how do you implement to your portfolio and what happened in the market over this last year. Well, this last year was quite a year. In fact, you would be hard-pressed to find any part of the market that was a good bet to invest in 2015. I guess it makes you feel better if you can see that really there were no real great winners last year. But in our life, we're not excited about that at all. Because if certain parts of the market are not doing well, then typically other parts of the market are. And here you can see that really we had paltry returns everywhere in our bonds. And for stocks, almost across all different asset classes, we had 100% losses, except for large company stocks. Now, before you get too excited and say, oh, I should have invested only in large company stocks, I have to tell you, it has not necessarily been the best thing for you. Why? Because there were 4 different stocks that did so well last year. And those stocks are called the FANG stocks: Facebook, Apple, Netflix, and Google. Those 4 stocks alone were the reasoning that the S&P 500 tipped into positive territory for 2015. Had those 4 stocks not been part of that S&P 500, we would have also seen losses here. Not so exciting for anyone. So how did the market perform? Well, over the last quarter in particular, this is the last quarter, October, November, and December of 2015, it was very much driven by investors viewing the daily events and making investment decisions solely based on the news. As we know, with our lizard brain training, this is probably the worst thing you could do with your portfolio. This is the performance of the world stock market, so it includes both the U.S. as well as internationally. And you can see that as we see headlines like the Eurozone economy slows as export weakens, we see a drop. We see then U.S. factory activity hits 6-year low, another drop. We see another drop. Fed raises interest rates citing ongoing U.S. recovery, another drop. and then worst year for S&P and the Dow since 2008, and that's where we end. This is what's happening. The news is definitely driving the stock market, and it's driving investor performance. And it's something that you don't want to be a victim of. So what are the main news drivers, and what do you need to think about? Well, the big news for 2015 is that the Federal Reserve raised rates for the first time in nearly a decade. This goes back to 1990, where the Fed funds rate was, and you can see through the last couple decades what has happened to our unbelievable lows that we've seen since 2008. So we have that little blip here, the first rise in the first time in nearly a decade, and we have projected out for 2016, 17, and ultimately 2018, where we project the Fed funds rate to be. This is a positive thing to actually have interest rates rising. Why? Because the Federal Reserve believes that the economy is in a stable place to be able to do this, and that the economy can handle these rises. But what does it mean for you? Well, it means two things. It means that your mortgage, credit cards, the interest rate is going to be higher. Particularly if you have a mortgage that is a floating rate mortgage, you're going to see it pretty immediately. It also means that the bonds you have in your portfolio are going to go down in value. Because if you can get a bond issued today at, let's say, a 4% interest rate, where that same bond, same risk, same everything was only paying 3% before, well, your 3% bond doesn't look so good. So within your portfolio, something that we've done over the last year is to make sure that the bonds you have are less sensitive to interest rate rises. And know that this is something that you need to make sure you have occurring in your portfolio. Again, moving towards less sensitive interest rate focused bonds. That would be floating rate bonds, that would be shorter maturity bonds. These are all different types of bonds that again have that insulation and are going to not see those losses in the same way. Another big factor that we saw was the drop in the drop in the rest of the market, but not in those FANG stocks. As I mentioned before, the return for the S&P 500 was 1.3%, but of that, Facebook had a 34% return, Amazon 117%, Netflix 134%, Google 44%. You can see these four stocks of where they are trading versus the S&P 500. So the returns that we saw last year, while, again, it was an awful market for pretty much everything except really those four stocks. The other news is falling oil prices. When we talk about commodity prices, of course, that's silver, that's gold, that's many other things. But the big story here, the big story is the falling oil prices, which is a boon to people like you and me in the sense that we can fill up our car at the tank for a lot less money. So the positive is putting more money in people's pockets. But the negative is that it has a knock-on effect in a very negative way to areas such as the companies that are fracking, companies that are big producers of oil or refining. And that, too, is definitely impacting the stock and bond market. And here you can see the crude oil here on the left. And as crude oil has come down, you've also seen a trend that the stock market has also followed it down too. So what about the dollar strength? The dollar going up in value, at least from my opinion, I love it. Whenever we travel to England to visit my mother-in-law, my brother, his family lived there as well, what I've noticed over the last year is that every dollar can buy more in pounds than I've seen for many, many years. So it's really nice because all of a sudden traveling to England is a little less expensive. However, it's not necessarily a good thing for people who are international investors. It's not necessarily a good thing for U.S. companies that get revenues from outside the United States. It's not necessarily a good thing for the U.S. economy, where when we're importing things, all of a sudden to those outside countries, the items we're importing is a lot more expensive. And in emerging markets, if you're investing in emerging markets, and many of the emerging markets currencies went down this year, the dollars you're getting back from that investment in emerging markets, if it's denominated in that local currency, you're not making as much money either. So this was another big story that we saw this year of seeing that the strength in the dollar has some nice positives for us, particularly some travelers, but does have an impact on our investment returns and also on the growth of U.S. companies. So what does this mean? Well, we're seeing a declining trend in profit margins. This chart goes all the way back to 1988, and it looks at the average historical net profit margins for U.S. companies. And what we're seeing is where we currently are. And where we currently are, which we circled here up on the upper right-hand side, is really showing that right now we have very high profit margins. And what has historically happened is that high profit margins are often followed by sharp declines, as we saw in 2008. Here we also are at pretty high profit margins, not nearly as high as we saw in 2007 or going into early 2008, but we do expect a continued dropping of profit margins. What does that mean? Well, that means that the earning estimates, the earnings of corporate companies may not be as strong as we've seen in the past. This is part of the reason for our base case of what we believe is the future over the next 5 years. We believe that U.S. stocks will not be performing at the same levels that we've seen them historically, in particular over these last 5 years. Let's keep on talking about that. Let's keep on talking about what is going to happen even in Europe. So this is looking at going all the way back to 1983, and we look at the European market right here in this beautiful blue and where we have ended up with current valuations. We also look at the U.S. stock market right here with current valuations, and then we look at global, which is emerging markets, developed, international, and the U.S. What does this chart show us? Well, essentially it's showing us that of all the places in the world, European stocks are trading at the most attractive valuations. Then global, and then finally U.S. stocks. So U.S. stocks are looking like, even with the recent downturn, that they're not necessarily cheap. With U.S. stocks not being cheap, it means that you getting a 20% or a 30% return in any 1 year from U.S. stocks, well, it becomes harder. It's kind of like going in and buying a car and you're paying top dollar for it, let's say $40,000, versus going into that same car dealership and being able to negotiate it and walking out with it for $30,000. If you need to sell it the next day, it's much easier to make a profit, or at least try and break even, if you paid $30,000 for that same car as the person who paid $40,000. This is, again, part of the research that we look at when we're making decisions for the long run. Now, what about emerging market stocks? It's a scary place. I agree. But what we wanted to show you now is that the emerging market fundamentals are actually now better than they've ever been since their crisis-prone years of I don't remember if you remember the 1990s and early 2000s. In fact, This shows you the change in current account balance, which as a percentage of GDP, which is a measure of strength, of financial solvency, of financial strength in these countries. And you can see the positive increases for all of these countries to the left of this chart. And really, only deterioration in a few countries. Are we surprised, though? Who do you see there? Yes, of course, China is one of those countries that we've seen additional financial deterioration. So what about investing in developed economies versus developing economies such as emerging markets? Is it worth it? Is it worth the risk? Well, this is a chart showing you that it actually is. Emerging market economies are actually growing faster than the developed world, like the U.S. Even with all the concerns we have politically, economically, it's still definitely a large piece of anyone's portfolio, again, for longer-term investors. So let's take a look at where we are today. 2015, in this beautiful teal, this is my favorite color, it's developed economies, the U.S., Canada, and the growth, the GDP growth, the growth of those economies is about a little over 2%. You then see this bump, the significant bump, and this represents the emerging market growth, or developing economies, well over 4%. In this gray, it shows you the growth differential. Now, this is according to the International Monetary Fund, the IMF, their estimates of from 2015 onwards. And what do we see? What continued trend do we see over 16, 2017, 18, 19, all the way to 2020? Emerging markets growth definitely has slowed, as you can see this, but it's still expected to outpace developed markets significantly, in particular over the next 5 years. So what does that mean? Well, it means that expected future returns of stocks and bonds may be lower than experienced historically. Historically, from 1986 through 2015, we've had a return of 10.4% each year from the S&P 500. Going forward, the projected return, nothing to get too excited about, 3.9%. Now, what about investment-grade bonds? These are those high-quality bonds. Really nice return, 6.8% return. On average, each year from 86 through this last year, 2015. Going forward, unfortunately, nothing to get excited about here either. So where do you go? Where do you go if the Holy Grail is not going to be in large company U.S. stocks, nor is it going to be in high credit quality bonds? Well, it goes back to the chart that I showed you with all the different types of investments that you should be in. You should not just be in high credit quality bonds. You should not just be in large company stocks. You should be in many parts of the market. This chart is our chart that shows you, based on a base case, a continued slow recovery, what types of returns might you expect each year over the next 5 years in these different asset classes. So the returns might not be coming from U.S. equities, but more so Europe, emerging markets, real estate. Now, what about fixed income? Those high credit quality bonds, 1.8%, again, nothing to get excited about. Instead, we're expecting higher returns from areas such as high yield bonds. They essentially have more risk to them. We have floating rate loans. So what should you do? You choose a good mix of stocks and bonds that works for you, that you can stick with in good times and bad. You make sure that among the stocks that you have exposure to not only just U.S. stocks, but developed international and emerging markets. Among bonds, not just mix of high-quality investment-grade bonds, but that you also have other types of bonds, such as high-yield bonds and floating rate loans that are less sensitive to interest rates. That's what a good portfolio does. That's what a good portfolio is needed for, so that in the good times and the bad, different parts of your portfolio are doing well. And when you get scared, and trust me, that's normal. It's okay to be scared, but I want you to think about this quote and maybe even write it on your mirror. That's where I put my quotes that keep me knowing how to look for the long term. Steve Forbes was quoted saying this: "You make more money selling advice than following it." It's one of the things we count on in the magazine business, along with the short-term memory of our investors. So when things get scary, remember, don't turn on the TV. Don't pick up a scary article on the newsstand. Call your investment advisor. If you don't work with an investment advisor, either get one or get a friend that you can be accountability partners for, buddies, so that you can stay focused on the long term. So that investment gap of up to 4.3% less in return each year, that's not you. If you ever need a second opinion, feel free to reach out. We offer a second opinion service to look at your portfolio, help you make informed decisions, and see into it in a way that maybe you never have. Sometimes you'll find that there's really not much that needs to be tweaked or improved. And with that, we are so happy and excited for you that you're in a good place. Other times you may find out that your portfolio is not necessarily a good fit for your needs, and we can help you with that. But either way, you receive personalized analysis of your current situation with no cost. Not to mention, it's great for us because we love to see how people are investing. It's really helpful for us to see how people are dealing with the ups and downs of the market. 80% of individuals said that they'd love to have a second opinion. So if that's you or there's someone you love, please let us know. You can reach out, email, call us. We're here. We're not going anywhere. So here's my information. I want to say a great big thank you. We're almost at the top of the hour, and I don't want to take any more time because we promised to finish this up by 1. You probably have more individual questions, and I can completely understand that, especially with everything that's going on with the crazy markets that we're dealing with today. So please reach out. You've got all of our contact information. We're here for you, and stay in touch. Thank you.